Hey, in this video, I'm going to teach you how to calculate interest-only payments as well as why you may want to use interest-only payments and what the scenarios might particularly look like for you. Hey, my name is Brandon. I used to be an electrical engineer until I was kicked out of the rat race, and my wife and I have primarily flipped houses over the last 20 years, as well as we're diving deeper into commercial real estate investing. And in this video, I just want to kind of do a little bit more of a dive on interest-only calculation payments. I did a video on this again several years ago, and it's been a well-watched video, but I also think that there's some different things that I'd like to kind of go over very quickly. And first, I want to talk about when this is a calculation that you may be likely to experience. And first, there's going to be, if you're utilizing private lenders, in many cases, whether you're borrowing for somebody's IRA or maybe it's a straight up, it could even be more of a commercial private lender. Maybe it's a hard money lender, and they're going to, maybe give you some points plus some higher interest rates. So number one, private lenders. Private lenders are going to be one of the sources of where you might be using interest-only calculations. Second, owner financing. And you may be thinking, there is nobody who does owner financing. And what's kind of interesting is the building that I'm recording in right now, the first mortgage is actually by owner financing, and the second mortgage is actually through a private lender by somebody's IRA. I make the payments every single month on an interest-only payment calculation. And the owner financing in this particular case, it wasn't quite a straight interest rate. It's more of just a principal interest type of a scenario. And then the third is a commercial bank. So I actually have a commercial bank loan right now that is interest only, and after a certain amount of time, it's going to convert over to be a fully amortized loan. So let me talk to you about, actually, let's kind of dive through a couple calculations, and I want to talk to you very quickly about when is that potentially going to end. So just to kind of give you a really quick idea of what this calculation looks like, the first example we're going to do is $100,000 at 5% interest only payments. So this is a very simple calculation, but all you do is you take $100,000 times 0.05, so you're going to move your decimal over two places, 0.05, and that's going to get $5,000. So that's on an annual basis, the interest only payments would accumulate to $5,000. Now to find out what that is on a monthly basis, you simply divide 5,000 by 12, and you'll get $416.67. Okay, so that's example number one. Second example, suppose we're borrowing $200,000 and it's going to be at 9.5% interest only payment. So you take 200,000 times, we're going to move the decimal over two places, 0.095, and you're going to come up with $19,000. So that's what it would be over the entire year. And then if we take that and divide it by 12 monthly installments, if your payments are monthly, that's kind of the nice thing with a lot of these installments is you can set them up to however you want. If you want to do it on a weekly basis, just divide 19,000 by 52 weeks. In this particular case, let's assume that it's a monthly payment. So we're going to take 19,000 divided by 12, and you're going to have a payment of $1,583.33 per month. So that is a monthly payment. Very simple, straightforward calculation. If you have any questions, just leave them in the comments below. But what I want to do is I want to talk to you about how the terms potentially end for some of these interest-only payments. A very common one is number of payments. Let's say that you've agreed to make 60 monthly payments that are going to settle out that loan and pay it off then at that point in full. Another one is a finite time. The finite time doesn't necessarily equate to the finite number of payments. Again, your payments could kind of vary slightly depending upon how you want to set them up. And another common one is your cash flow threshold. Let's say that you have an agreement set up with somebody that once you achieve a certain cash flow on that investment property, at that point, then it'll convert to a fully amortized loan. And that might be something that a small commercial bank might set up with you, but I hope that helps you. Again, if you have any questions, let me know. And if you have not subscribed to my channel, please hit the subscribe button. If you enjoyed this video, give me a thumbs up. I would greatly appreciate it. Thanks, and we'll talk to you in the next video.